All right, well, we certainly have a quorum. Looks like we have everybody. So, welcome to the regular meeting of the pension board, January 22nd, 2026. I believe all members are present in one way or another. Jim Joaquin is our newest member. Jim, I'm gonna have you do a little introduction and tell us who you are.
Good morning, everybody, and I apologize for not being there in person. I am a proud resident of Old Saybrook, and I recently retired, well, a year ago. I was the president and chief operating officer and general counsel for the Simon Conover Company for, well, most of my career. I'm a lawyer by trade, and they are a privately held real estate conglomerate, owners, developers, managers, contractors along the East Coast, half of the United States, approximately 6 million square feet among diverse food groups, hotels, shopping centers, commercial office buildings, development projects, etc., with a focus in the Mid-Atlantic and Northeast. So, but my career, I segued back to civilian life, as they say, last year, and it's been my privilege to get involved in the town of Old Saybrook, and it's a pleasure to be with you all.
So, Jim, online we have Lorraine Cortez Costa, who's one of our members. Leland McKenna right there.
Morning.
Lorraine's also
Good morning.
an intern. Leland works up at Middlesex Hospital. Paul Tracy. I don't know if you know Paul. Paul lives out your way, and of course Leanne. And then in the room, why don't we just go around and introduce ourselves to Jim?
Hi, Jim. My name is Melissa Lewis. I am taking over for payroll and benefits coordinator.
Good morning.
Morning.
Hi, good morning. My name is Amy Jensen and I'm the assistant finance director.
Hi, Amy. Good morning.
Good morning, Jim. You know me. I'm Barbara Labriola, the town treasurer.
Hello, Barbara. I do know you. Good morning.
Hi, good to see you, Jim. Kevin Nichols. I'm a senior institution consultant with Morgan Stanley. We've been working with the town of Old Saybrook pension plan for the past 35, 40 years.
Kevin, it's a pleasure. Thank you. Happy New Year to everybody.
Good morning, Jim. My name is Becky Lilly. I'm on the Morgan Stanley team.
Good morning, Becky. Happy New Year.
Happy New Year.
And Jim, officially welcome. This is Susan Quish.
Hi, Susan. Thank you again for the accommodation, and Happy New Year to everybody.
And last but not least, I'm Rowena Moffett, Jim, and we haven't met, but I think you've worked with my law firm. Have you worked with Mitchell Jaffe at Brenner, Saltzman and Wellman?
Mitchell and I were partners at Chasten, Schatzer, Bickoff, and Kotkin back in the early 80s. Yes, through 95. Yeah. Wonderful man. Well, love Mitchell.
You and Mitchell have taken similar career trajectories after Schatz. Mitchell retired this past year as well.
Wonderful. Wonderful man.
And Christy, morning.
Hi, I'm Chrissy. I'm the recording secretary. I
Morning,
also work
Christy.
with Lee.
All right. So that's a wrap on that. I don't believe there's any members of the public online.
No.
So we'll just jump into the approval of the minutes. I'll accept a motion for approval of the November meeting minutes as presented. Is there a second, or is there a motion?
So moved.
So moved. I'll second. Leland, you'll be seconding. And any comments, questions, any amendments? Hearing none, all those in favor signify by saying aye.
Aye.
Alrighty, motion passes. Action items. Leanne, I think this is going to be you. Discussion and possible action on plan administrator recommendation.
Yes, good morning, everyone. Happy to be with you from afar. So several years ago, the town decided to create the position of plan administrator. And as the finance director, I have had that role for several years. Right now, we are looking to make sure that we have dual coverage on all of these things, especially since I'm down here in South Carolina. A lot of documents need to be signed, et cetera. And also we need to just make sure that in anyone's absence that we do have coverage. So this recommendation is simply to enhance the role of plan administrator to two, the finance director and the assistant finance director, which is Amy Jensen, who's there with you. Since Janet's retirement, we want to make sure that we have all our I's dotted and all of our T's crossed. So we are requesting that the pension board approve two plan administrators. And I guess we have a lot of new folks on the board. So the duties in general of the plan administrator are to, when a person retires, to go through all of their benefits, to work with our actuary, Milliman, and not only retire, I shouldn't say just retirement, but if a person leaves early and they're getting their contributions back because they're not vested, processing all of their retirement requests, making sure that everything goes through, and of course, working as a liaison with the pension board to bring forth coordination from Morgan Stanley, Milliman, our healthcare providers, and any other business partners that we may have that work directly with the pension board.
I'd like to make that motion.
For a second.
Second.
All right, any discussion, any questions?
I have one,
Yep.
always. Leanne, the only question is, this makes perfect sense to have a person or persons appointed in this role. I'm just not clear as to what we're doing now.
So right now we only have one person, that's me, approved. And so we're requesting that you do it and by position, not by person. I think it's the last time it was approved, it was in my name, but we're asking for the position of finance director and assistant finance director to be approved as plan administrators so that, you know, it's an evergreen process here. Does that answer your question, Rowena?
It does. And then leads me to my second one. So, you know, when you appoint two people to do the same thing, sometimes there's an issue about whether you have to act unanimously or whether it's really the plan administrator or in that person's absence, your position or in your absence, the next person. Is that covered in the recommendation? I probably should have read the recommendation. I read the recommendation, but the proposed.
It is not covered, but that is in practice. So perhaps we should have been a little bit more clear. So I will say it and we can put it in the minutes that the finance director is the primary plan administrator. However, you know, if I'm on vacation or not here, we need somebody to have the business carry on. So in that case, the assistant finance director and Amy and I have had that discussion that, you know, all the business needs to go to the primary plan administrator first to make sure that they know what's going on, et cetera. And then in their absence, the assistant finance director would sign.
So why don't we clarify that, and why don't we amend the motion that's on the floor to say that the plan administrator is the primary, the finance director is the primary plan administrator. And Leanne, maybe you can craft the memo, but in the meantime, we'll approve it. That the finance director's primary is the plan administrator. However, in the finance director's absence, disability, whatever, we can put the language in, the assistant finance director will assume that role. Something along those lines?
Yes.
So I'll make that as an amendment to the primary motion.
But may I ask that the intent being clearly that either signature carries the full weight and authority as plan administrator?
Correct.
All right. And with that further amendment, so it's on the floor. Leanne, Chrissy, you have that, right? So
Yeah, I'll replay
and
it.
we'll amend it and we'll pass it around. We can do this at the next meeting, but and when we have a final draft too, I suppose. Leanne?
Yes, I don't, it's fine this meeting or next, whatever is the pleasure of the
Well,
pension.
why don't we do it at the next meeting? Why don't we rewrite this?
Okay.
And we'll circulate it.
Okay,
And then if there's any questions on that, and so,
the
we'll have-
only, yes, I will do that. The only possible obstacle would be if something needs to be signed in the interim. And if that is the case, then Amy and I will work out. Yeah, so,
if it needs to be signed in the interim, we'll get you to sign
Yeah.
it.
okay, sounds good.
I think we'll make it the month. Paul, withdraw the motion, everybody will withdraw our motions and amendments.
Okay.
Okay. We'll just go away. All right. Jim, your dog is beautiful.
Dr. AC?
So,
Aw.
all right. So, we'll move on then. Thank you, Leanne. We'll have that ready for February. We'll move on to the pension report, DB and DC tracking and gross payroll.
Hey, my turn to do this.
Wow.
Oh, first time. So as of the January 1st pension, the town police and board of ed had 101 retirees with a gross payroll of 179,434. One addition of Lieutenant Walsh, who retired in November, has been added to those numbers. Plus, there's one QDRO spouse, so a total of 102 participants. The fire department has still the same 39 retirees with a gross payroll of 16,772, plus one QDRO spouse for a total of 40 participants. Pending retirements, Daniel Briganti, a Board of Ed custodian, has announced his retirement effective February 1st with 13 and a half years of service. And Jeffrey Warman is eligible to commence his retirement from fire department, also February 1st with 8 years of service, and he will receive the officer incentive benefit.
Can I ask?
Yeah.
On that, Jeffrey Warman, it says is eligible. Is he intending to retire? And is the vesting period on the fire pension 5 years? I can't remember.
So he is intending to retire.
Okay.
That is, Janet assisted me in
Yeah.
preparing this, and that was the language that she
I believe
and I
it
didn't-
is 5 years.
I
I
recall.
believe it is, yeah.
Yeah, same as well, but. it's
How many
5
years? 5 years?
5 years.
Okay. I didn't know if the language was different because he's a volunteer firefighter as opposed to, paid employee. Stephen Hackett, a former police officer who is fully vested with approximately 11.7 years of service, has requested a cash out. And so, I have been in touch with representatives of Milliman to request, that calculation. He's still actively employed in a different municipality, but he's just looking to recoup the money or take the money. As of the end of December, the active employees for both the DB and DC plans, the defined benefit pension plan has 26 contributing police officers, 26 town employees, and 19 Board of Ed employees for a total of 65 participants. The defined contribution for one retirement plan it says 47, but as of this week, it's 48. We just hired Melissa's replacement. And then 33 contributing Board of Ed employees for a total of now 81. And the total plan balance as of the end of December was $2,946,826. And the town's 457 plan has 90 active employees and a total plan balance of $5,678,800. 79% of the DC participants have elected the additional employer match, which includes the new hire that just came on this week. And that breaks out to 89% of the town's employees and 64% of the Board of Ed's employees.
So, Jim, how familiar are you with the town's pension plans?
Well, I'm familiar conceptually and generally with the pension plans. I sat on the Conover pension.
Yeah.
I was the plan administrator for the Simon Conover company for
Right, so-
years. So
So, the town, only had one pension plan up through July 1 of 2017. We had a traditional municipal pension. It was a 5%, mandatory employee contribution. And then, the employer matched 5%, but we were actually putting in a little bit more because we were the plan was underfunded, but, and then, we sunsetted that plan except for public safety, which is, police only. So the police officers have an option to be on the defined benefit plan or the defined contribution plan that was commenced on July 1, 2017. As you can see, if you have these documents in front of you, the plan has basically flipped to, it's amazing how many defined contribution folks there are. It's double now, and just over the years, how that has just changed. But we will always have a DB plan. In addition, on the town has a 457 that if you're in either plan, you can elect. And it up to an additional 3%, which the town will match. And that would be true if you're in the traditional pension or the DC plan, which is a 401A plan, under IRS regulations. That's in a nutshell. I'm not giving you any more at this point. If you want more, you're gonna have to come in. Does that make some sense?
It does. Again, conceptual sense. Seems like you need 4 administrators, not just one other.
Well, Leanne and Carl have done a great job of getting it down to what it is. And I wonder if this is a great opportunity. Leanne just went through a huge overhaul of, really both plans. And I'm not sure that I could find the current plans. Did someone take it upon themselves to send Jim the current set of all 3 plans? And if so, I'd love to get another copy.
So, if I may, this is one of the things I was going to report on, is that we have now, as Rowena said, gone through our plan document for the town plan. We have the fire department plan document, which has been updated a couple of times, and we are still waiting on Empower to get back to us on the last changes that we made for the defined contribution plan. When that is done, we will have all the documents, and Chrissy and I have been talking about putting together a brand new book for everyone that has all of those documents in there. So I'm just waiting. I don't want to put everything together and have one plan outstanding. But Jim, if in the interim, if you are interested in reading up, I'm happy to send you the things electronically. But we are waiting just to put everything together for everyone.
I'm fine waiting until you have everything together the way you'd like to present it.
Thank you.
Thank you.
I know on the DB plan, we did have one recent death. Kathy Marshall, I understand passed.
Oh, no, I didn't know that.
Yeah, Janet let me know over the weekend. So I don't know, Kevin, I don't know if you remember, Kathy Marshall was in the building office with Don Lucas for many years. I don't really remember how many years, but I assume she was here long enough to be vested. Does that name ring a bell?
It does.
Oh, yeah.
I mean, not to me, but.
And she ended up, she was very forgetful for a while there. She was in her 50s. And then we sent her out because she wasn't doing her job, we sent her out for a fitness for duty test, and she was not fit for duty. She had early onset. And that was probably 6-7 years ago, and I guess she's recently passed, but we were a little disturbed because she elected, we're gonna get this a little bit wrong, early retirement. And she was so close to being to full retirement at 62. We were like, can someone talk to her because she's forfeiting this money? And but she took it, and it may have been good that she took it, because at that point, because she has subsequently passed. That's what Janet told me. I hope I'm not reporting something that's not true, but I wouldn't doubt it, so. I don't know if that's reflected in the numbers or not, anyway,
It is.
so, go ahead, Amy, I interrupted.
No, that's okay. That was not reflected in these numbers. So I will update my figures.
Are you done, Amy?
Yeah.
Okay. All right, we'll turn it over to Kevin. And.
Yeah. We're just gonna pull up the research slides, just, a lot of the deck wasn't ready by the time we had to get this out, so we're just using the Global Investment Committee's kind of weekly, synopsis or snapshot. Just kind of things to kind of highlight here is that, we're expecting a lot of new, equity leadership going into 2026. So, we've got the AI sort of boom take over the last 3 years. We've talked, I think, kind of ad nauseum about that and the things that we feel like are risks to that. We'll get into some of those slides a little later on. But things are changing, like value, whether it's in small cap, mid cap, or large cap, is doing much better than growth over the last, 3 to 4 months.
I love it when you're proven right.
One of the, well, no, it's not proven right or anything like that. It's, we were actually just at a meeting the other day and, a lot of pensions, a lot of funds have had really good returns, okay? And, somebody was comparing it to an endowment, and another person was comparing it to a hedge fund return. And it's like, those things are completely different than what a pension is supposed to be for, right? We know what the pension is supposed to be for. We want to hit the actuarial assumed rate of return or better. We want to reduce the burden on the taxpayers. We want to get this to 100%. We want to pay the liabilities. That's like plan, right? That's exactly what we feel like our job is to do, is to make it so those things are most likely, going to happen regardless of what's going on in the markets in the world. So we've been diversified for a long time, okay? International, emerging markets, which finally have done well last year, after years of underperforming. But the leadership actually is changing, okay? So in the last 12 months, okay, NVIDIA is up 25%. Spectacular, wonderful. Caterpillar Tractor, okay, which is a very cyclical company, is up 62%. All right, so you're seeing that while AI has done really well since Liberation Day, basically, back in April, there are a lot of other more cyclical companies that have actually done a lot better, okay? And the divergence between the Mag 7 now, which used to kind of trade in tandem, is really widening as well. Now, that being said, if you want to go to page 3, the 10 largest companies share of the S&P 500 market cap is still at, an astounding 41% upper right-hand corner there. So that's, a third higher than the highest point ever, right? So we're still at a point where there's still an unbelievable amount of concentration in the market. And we feel like, that's going to be a risk going forward. So being more diversified, in sectors, in geographies, in market caps is going to be helpful as we kind of move forward. If you just want to go to the next page, page 4.
Kevin, you said being more diversified, but
Yes.
Are you saying our portfolio you feel
Is diversified, yes, and that's been unfortunately to the detriment of performance over the last few years, because being concentrated was helpful, right? If you were in large cap growth or if you were in AI, then you did spectacular. If you were diversified, that was a detractor of performance, right? International did nothing for a long time. Small caps and mid caps really went nowhere. It was large cap growth or nothing else, really, is what you need. Now we're at a point where small caps are doing much better. International is doing much better. Emerging markets are doing much better. Bonds are doing very, very well because yields are starting to come down on the short end. Okay, on the long end, they're actually going up. We'll talk about that in a little bit. But when you look at this chart here, okay, this is one of the reasons we want to be sort of diversified, because this is an international macro factor heat map, and we have one for the US as well. But you can see a lot of these are are blue. Blue is good, gray is sort of like mediocre, and if it was, like black or something like that, it'd be, bad. But basically, a lot of these factors are trending in the right direction for Europe and for emerging markets, right? Whether it's growth, cutting interest rates, deflation happening, sentiment becoming more of a, leading the inflows in terms of money going into these economies. Those things are starting to happen. If you just want to go to page 7, just quickly, we always like to talk about what our estimates are for the next year. Just hold the page after that. Yeah, upper right-hand side, you can see our base case really is 7,800 in the S&P, so we are expecting another double-digit gain, again, with broadening out in terms of the sectors that are contributing. But just want to point out one thing is that is also taking into consideration a contraction in the PE multiple. We've been talking about how multiples have been very, very stretched for a long period of time, especially in the US, so everything's kind of quote unquote price for perfection. So we're expecting earnings growth of around 10-ish%, but we're also expecting a contraction in the multiple, meaning that tech probably isn't going to do as well, and a lot of the lower value stocks might do a little bit better. And when you look at, if you just want to scroll down a teeny bit more on this page, the bottom page gives you the relative value here. Sorry, I don't know if you can get like the bottom of this page, but I don't know if you can, there we go. So this gives like the percentile, the percentiles of where we are for valuation, and you can see a lot of these numbers are in the 80 or 90th percentile. We talked about this in terms of valuation for the U.S. markets, especially, and the equity risk premiums being very, very low. So, hasn't helped to be cautious. We recognize that, but it hasn't, hurt in terms of the actuarial valuation and in terms of the, hitting the actuarial assumed rate of return. And you'll see as we get into the performance that, we're still on track for that for this fiscal year as well.
So just quick question, a comment and a question. The Board of Finance the other night, we report, the treasurer reports on the pension every month and talks about the return. And unfortunately, it's like, this is the return, this is the benchmark.
Yeah.
And we have 2 guys in finance, financial advisors on the board. So guess what? They said, why are we missing the benchmark?
Right.
So I said, I'll tell you what, let's get through the budget. And then you can zoom in one night, don't and talk about, Leanne did give the explanation the other night, she fine explanation. But I think it'd be good to hear from you about how we're paying liabilities, and the primary goal of the plan is to pay the liabilities and achieve as high a return as we can while doing that.
I think too, one thing to kind of think about is, or one thing to note is, active management had a really tough year last year. They just did. All right. So like most of our active managers underperformed. And one of the reasons that happened was there was, I think I may have talked about in September, this beta rally that happened. Okay, so there was this beta rally that happened basically in the last half of the year, which means that high momentum, low quality, most shorted stocks, for example, okay, with no earnings, did very, very well. Speculative stocks did very, very well. And low volatility, high quality stocks did poorly, okay, from basically, I'd say, like June, July onward until basically mid-December. There's a lot of speculation market. In mid caps, okay, the difference between the low quality and the high quality stocks was around like 2,000 basis points, okay? That's, 20%. In small caps, it was 3,500 basis points, just in that time period. And the percentage of companies that are unprofitable in the Russell 2000 right now, which is a small cap, just to give you a sense, is at 42%. Almost half of the companies. So if you are an active manager, okay, in a small cap, let's just say, and you're a quality manager, 42% of the companies you are never going to invest in because they don't have earnings and they don't have the financial strength of a company that you would feel, you know, good investing your client's money in, right? But unfortunately, those types of companies did well, and the types of companies that you have that have financial strength did poorly. And so you're gonna be looking terrible against the index, and you can see that especially in the small caps. And we addressed that a little bit with the mid cap by moving some of the money to an index fund, right? That has since sort of reverted, all right? So when we look at sort of the numbers for the first, 21 days of this month, you can see that the small cap manager is up, 526 versus 4 for the benchmark. Kane Anderson is up 386 versus 3 for the benchmark. So these things are starting to revert, basically, right? And I know I talked about Cypher Mining was one of those companies. I talked about the Bitcoin miner that was very volatile from being a penny stock to a $20 stock very, very quickly. That's just an example of some of the stocks that have had that type of price movement. But those have, since reverted with the volatility that we've, seen in the first month here.
So that was my comment, and
Yeah.
the question is, you were talking about a contraction in multiples in price to earnings, I guess, right, PE? That you're hoping for in some of the stocks that we will be holding. But what are the PEs now on those stocks, and aren't they already at an all-time high?
So for a lot of the problem is a lot of the
Like Catapult.
Okay, a lot of the stocks that have very, very high PEs are the Mag 7 or the top
Right,
end stocks,
understood.
right? They're at like 50, 60, 70, some of them are in the upper 90s, whatever it may be. So that's drawing the entire index to look very, very expensive. There are other stocks within the SP 500 that are trading more like, 15, 16, 17 times.
Okay.
So those are the types of stocks that I would say we're looking to invest in, and that are gonna have at least earnings growth. So even if the multiple stays the same, then the price can still, improve, right? Whereas if the fundamentals maybe are deteriorating or not getting as attractive in the high PE stocks, those will probably contract. So,
Paul, Tracy.
Yeah, hi. I just wanted to reinforce a point that Kevin made earlier. The idea that all of the weighting was in 7 stocks, which represented really 35 or 40%, as I recall, of the market at that point, those $1 trillion stocks. So there was no way that we could keep up with that without taking the same kind of concentrated positions, which we're not going to do, in my opinion.
Thank you, Paul. Yeah, I'm sorry, any other comments online? I don't wanna, sometimes I forget to look up that way. So just feel free to jump in if you need to. Okay,
I would just say too, like, happy to meet with the Board of Finance whenever is, appropriate and everything like that. We're always available. So just let me know, when it works, and we're happy to come up and present.
there's been a lot of turnover on that board
Okay.
also, so I think that's another reason to maybe just come in and give a 15 to 30 minute bang.
Just
out.
zoom in, you don't have to drive all the way out.
Yeah, whatever you choose.
You love to
Yeah.
drive up, I know.
Here at 8:30 in the morning, it's no problem here at like 6 o'clock at night.
Okay.
It really is
That's fine.
dinner.
He does love to come in person.
The pension benefit board meetings used to be actually in the evening.
Yeah,
I remember, like a few years ago, so.
Oh, I remember.
No problem.
I changed that.
I love having a morning meeting instead of a night meeting. I'm tired of night meetings.
I think the net of it is though, is yes, very difficult year for active management. What we're seeing in the early innings of, 2026 is again, a broadening out and a much more, breadth of the market participating. And that's, again, throughout sectors, throughout, market caps, throughout geographies. And that is leading to, outperformance for us, finally, right? In the beginning of this year. So at the beginning of this year, and this is, this is not in the numbers yet, but we're up over 1% year to date versus the IPS, which is basically flat, and the 60/40, which is down 51 basis points. So, it's a short time period. It's a month. We meet every month, okay? Not a lot really changes month to month. But you're seeing the early innings of international doing better. You're hearing about, a lot of these European countries and pension funds are gonna start selling their treasuries, which is gonna make the dollar a lot weaker. Okay, and if the dollar is weaker, then that bodes well for international and emerging market stocks because they can convert their earnings into more dollars, okay, which gives them more revenue basically in US dollars. And also for multinational companies that have offices abroad or manufacturing abroad or whatever it may be, right? So we feel like that type of that part of the market is going to actually do very, very well. Where those that are more, concentrated in the US might be a little bit more, a little bit more at risk, which is completely a 180 from when we think about when the tariffs were actually implemented. Everyone thought they were going to be, negative for international emerging markets. They've actually been very, very positive. Any questions before we move on to performance?
I would just like to ask about bonds. You said earlier you're going to discuss bonds further. So
Yes.
I'm kind of holding off, but I'm wondering about the underweighting in the investment grade and I'd say full weighting in the junk bonds.
Yeah, so that's a great question. So two things about that. I just want to turn to page 10, maybe. We'll just kind of address that right off the bat. The first thing is when we look at the IPS targets here, okay, still overweight short-term bonds, okay? And I know that there's been a lot of discussion about, the lowering of rates. The Fed obviously has cut the last 3 times that they've met. They're not expected to cut the next meeting. They're actually expected to cut possibly in the later half of the year because I think they're going to take a wait and see approach. Inflation is still something that they're very concerned about. CPI is not really the measure that they look at. They look at PCE. It's more closely tracks, what they're trying to do. And then you have unemployment starting to tick up, obviously, because of the layoffs due to AI. One of the things to keep in mind is that since the Fed started cutting, okay, the 10-year yield has gone up by 30 basis points. All right, so kind of counteractive to what people would think about. The short end has come down, of course, like the 2-year, 3-year, 1-year bonds. Those used to be paying 4.5. Now they're paying like 3.5, 3.75, somewhere in that range. But the 10-year went from basically 4% to 4.30. And so there's still this expectation that rates are going to be higher for longer. And we've stayed short term, which I'd say for the majority of the year last year was not helpful, but for the last quarter or so has been more helpful. So we still feel like could be a lot of volatility in the longer term bonds due to this treasury selling. And that's one of the reasons that we're staying, short term. And Morgan Stanley's forecast, just, for the 10-year is still at like 4.05 for the end of the year. So a little bit less than what we have now, but we're expecting the 10-year to be pretty sticky. So it's not like, if there's things change, we certainly can go longer duration. We've been kind of ticking up duration a teeny bit, without having to give up, a lot of yield on the longer end of the curve. Now, in terms of high yield, if you can see here on this page, we're at 777. Our target's actually 10. So we're just over the minimum amount in high yield. High yield, is something that, we're kind of, I'd say, like neutral on. Spreads are still very, very tight in high yield. They're very, very tight in investment grade as well. And there hasn't been really any, credit events as of yet. But, it's been giving us a good amount of income into the portfolio. But we're just not at a point where we want to take a lot of, I'd say, credit risk right now. If spreads start to widen out, that might be something that we look to add, but not anything that we're, actively going to change against in the future.
Yeah, in the somewhere, I think it was on the bottom of page 3 where it was dark printing. within that area. I think the point was made that the junk bonds are relatively unattractive at this point because of the narrow spreads. And I
Yeah.
was just wondering, is there something else? Personally, I don't consider junk bonds to be bonds. I think they're more like stocks. But is there something we should be doing there with the junk bonds, moving them somewhere else where there's more opportunity?
No, that's a great question. I think that, when we had this discussion of adding junk bonds like years ago, the thought was, yes, they are more equity-like, they have a lot more volatility to them, but they also pay obviously a higher coupon. So I think having the lower weighting that we have right now is reasonable. And we certainly have moved money from, over time, at least from, the junk bonds into the more, high quality bonds, even though their spreads are very, very tight too. We feel more confident in the volatility of those investment grade spreads than the volatility of the junk bond spreads. And yes, I agree. We completely agree with you. They are more equity-like. They have equity-like, volatility to them. And also the junk bond markets changed a lot in terms of, post 2008. The credit quality of the actual underlying index is a lot higher than it used to be. It's still junk bonds, don't get me wrong, but there's a lot less, super low quality in the index, than there was, let's just say, 15, 20 years ago.
Yeah. Yep. Thank you.
Yep. Only page 4. Okay.
Sure, yeah, I can kick off, the overview page and, just looking at the top left-hand corner. The column on the far left is the custom period. That is for the fiscal year to date, so that is not for 2025. And you can see, beginning value of just over 29 million, ending total value of just over 31 million. Return gross of fees was 5.72 and return net of fees of 5.36. So those are, as Carl pointed out earlier, underperforming the benchmarks. But we just have already had a conversation, and Kevin has pointed out kind of our strategy. And it's actually really interesting when you look on that middle column, the last 5 years, it really does highlight our strategy. Is that if you look at the beginning total value, just a little bit over 27 million, net contributions and withdrawals was 3.44 million. And then if you look at the total income received, nearly identical, just even a little bit more, 3.443 million on income received. So that left the depreciation at just over 4 million. That just literally added to the bottom line of the portfolio. And that is, that is a hallmark. And in a couple pages on, we'll see that, the last 5 years is actually not our best performance. And so here, the return net of fees of just over, or just about 5.5%, do seem to be, or are, underperforming compared to the benchmarks at a 60/40. But that's for that particular time period. It looks quite different at other time periods. In fact, if you look at the column farthest to the right, performance since inception, you'll see that that's much closer to, we don't have the IPS benchmark there, but much closer in terms of getting to the benchmark. But really it's that middle column of, portfolio construction that leads to lower volatility, higher income. That way in good markets, bad markets, flat markets, we are meeting the liabilities of the pension.
Just want to say too, fiscal year to date, as of yesterday, up 6.42%. Right, so we're tracking in terms of what we need for the actual assumed rate of return, and then the fund balance, as of yesterday was at $31.4 million. So we've already made another, 400,000, 300,000 plus, in this.
Well, it depends whether you
Right.
go by Tuesday or go by Wednesday.
Correct.
Exactly, this you guys did yesterday, all right, but the bottom line is, again, the fund balance is at
It's a
an
roller coaster.
all-time high. And what we really wanna see on this upper right-hand side is the convergence of these two lines, because this is, again, the spending portfolio, right?
Yeah.
So the black line is, what would be if we put the money under the mattress, that wouldn't be a good situation.
Right.
But you can just see the lines really started to, we really started to spend down in, let's call it like 2007, 2008. And, it's gotten higher and higher, so obviously more and more retirees come in, we are expecting that. But the good news is that, the fund balances continue to grow, which means the fund ratio is going up, and that's,
Well, the town since 2000, well, I'm just gonna say, speak for when I came in here.
Yeah.
Obviously, 2008, we were overfunded in
Yeah.
2008. We were underfunded in 2011 when I took over, I think 60s, something. like
That seems right.
And we've, just for those online who don't have that history, we've made a lot of headway, and now we make the actuarially defined, I know it's actuarially defined employer contribution, ADEC. And we've added money to the pension over the years, and so we're in a much better place and the market's been, thankfully, the portfolio has performed well. But the town has made a concerted effort to get this plan where it is today.
Correct.
And thankfully, we've had cooperating markets for the most part.
Yeah, there was a time period where the ADEC wasn't being met, and now under your direction, it's been a lot more consistent, and we appreciate that, and that's been helpful in terms of, getting the pension plan where it needs to be. Sorry, go ahead.
Yeah, I would just say, again, looking at the bottom right-hand corner, that is the income summary for 2025. So that is year to date, not fiscal year to date. And you can see there that, in 2025, 755,000 was generated in total income. And a really nice distribution between the equities of just over 300,000 and the fixed income really having a nice contribution of 378,000. So something that we're, always looking at, in addition to the asset allocation and the manager selection, is the ability for us to achieve a really good income. I'm gonna take the next. You're
Yeah,
gonna go
sure.
over the
Yeah.
risk return.
I just want to, if you want to just go back if you want to go to page 11, sorry, Paul, I just want to let you know, I was looking at the fire pension when I was looking at the high yield bond, so we
Yeah.
are overweight high yield in the town pension. That is something that we're looking to reduce.
Yeah.
So we'll be reducing some of the high yield and putting that into investment grade. So I apologize for that.
Okay.
All right, yeah, if you was on page 5. Page 5 is our risk return over the last 3 years. You can see, the volatility, we have slightly lower volatility than the IPS benchmark. Net of fees, the return 11.44%. So again, much higher than the actual assumed rate of return, but much lower than the benchmark. When we look at the next page, upper right-hand side is really something that we want to kind of focus on. We can look at the portfolios, the dark blue, relative to the black. And this is the sort of like the worst periods over the last, I don't know, 20 years or so. And you can see that, every single time that there's a lot of volatility in the portfolio, we're protecting a little bit better than the benchmark, right? And I think the last time we saw that was 2022. But the whole point of the portfolio, again, is to be more protective. And this is considering a lot of these time periods, we had a lot higher equity allocation than we do today. Page 7, just want to look at, we're basically at, 65-35, give or take a little bit in terms of the asset allocation. We've really been there for, the last few years. We did take down the equity allocation, starting in, I'd say, like 21, 22. Page 9 again goes through sort of the longer time periods. You can see the last 10 years, the gross of the return is 820 versus the net 742, close to the IPS benchmark at 872. Page 11, in terms of overweight and underweights, again, we're pretty much slightly overweight large cap, underweight mid cap, overweight small cap, pretty much equal weight international, overweight emerging markets, overweight short duration bonds, and overweight high yield. Next page. So this is like last 3 months to the quarter, how things done. You can see again, international done very, very well relative to US markets. Large cap actually did very, very well though. And short-term fixed income actually did a teeny bit better than intermediate term fixed income. And when we look at sort of like the month to date and quarter to date figures on page 13, parametric, the second account down that ends in 365, that's our short-term bond manager. Okay, you can see up, for the fiscal year, even up 243 versus 225, our intermediate maturity manager. For the quarter, up 112 versus 91, but for the year, lagged by about 60 basis points, 593 versus 654. On the manager page, just kind of will show you, at least in terms of like the month to date numbers and some of the quarter to date numbers, how value has done much better than growth. And you can look at, a Davis large cap value is one of those sort of, I guess, harbingers or whatever. Quarter date up 820 versus 381. Davis is actually up about 2% for this month versus the S&P down 0.65%. London, while they had a tougher quarter, has done better this year, up 270 versus again down 6.65 for the S&P 500. Even John Hancock, which is supposed to be a little bit more in line with the S&P 500, is up about 0.6%, again versus the S&P down 0.65. You can even see here, Kane Anderson getting a little bit better for the month. And then when we look at sort of like the longer term numbers, again, on the year to date, you can see Schroders International Alpha up 29% and Lazard up 24% being, again, contributors to the portfolio. And high yield, even though we're gonna, think about reducing that because the spreads, up 865 for the year to date. Relative to Boyd Watterson and the corporate ladder short, which was a little bit less in terms of return. So again, well diversified in terms of style, well diversified in terms of geography, and we're starting to get contributions from places that were participating less in the last few years. Any questions there?
Kevin, I remember you switched one particular manager, and
Yes.
I can't remember which one it was.
Yeah.
Could you point out how they're doing?
Yeah, so that's Davis. We added Davis and the London Co. So they are more value and income orientated. And I think we took some money away from, I want to say Aristotle and John Hancock, if I recall correctly. So those two managers are more basically looking for companies that have lower price earnings ratios than the market. And London especially is looking for companies that are paying a good level of dividend and then are increasing those dividends at about 5% per year at least. So that's going to give more income to the portfolio in terms of the dividend income that we're going to receive. And also, provide a little bit more balance in terms of value and growth in the portfolio as we have, John Hancock, which is going to be a little bit more growthy, but is more of a core manager. And the S&P 500, which we have in the ETF there, a little over $1 million, which is going to be more in line with obviously the index, right? And we've been reducing that due to the concentration as we talked about.
Kevin, so just take any of these, John Hancock, Aristotle, whatever you want to take. So I assume, you have the discretion, obviously, to invest, make recommendations, but basically do it in terms of a manager. if we were to, and I assume you have a universe of managers that you choose from, and they are. I believe we could probably pull up the chart of the John Hancock peers.
Yeah.
And then take an ETF or of a similar, it'd be interesting to see, I think. Where John Hancock rates, where just 5 years even. And I'm not calling you out on this, I'm just saying, I think it'd be. Maybe an interesting exercise, I'm not trying to make too much work, if it, whatever.
It's not. So what we used to do, just so you know, a few years ago, is we had the profile of the managers in the back of the reports, okay? We can start doing that again. On a quarterly basis, they come out with, we have a global investment manager team, okay, it's 60 people at Morgan Stanley that is separate from our team. That is doing due diligence on all these different ETFs, managers, whatever it may be, right? They come out with a quarterly report, it'll show, you know, them versus their benchmark and versus their peer group.
I think that'd be interesting. to
Okay.
see.
That's fine.
Yeah.
Yeah, we can include that.
But more than a quarter, obviously, it would show. maybe
No, I'm just saying every quarter gets updated.
Yeah,
Yeah,
right.
they show the longer term track record and where they rank and everything like that. So yes, yeah, I think that's totally fine.
Yeah.
It's been really interesting in that, in 2025, the big topic of conversation at the beginning of 2025 was, why are we in an international? Why are we in emerging markets? That's what everyone wanted to talk about. And then they had international and emerging market had a tremendous year. And so it was not the time to pull back from those allocations. At the beginning of this year, virtually every investment committee meeting that Kevin and I have had, it's about benchmarks and it's about the indexes. Well, why are we paying for active management? Why aren't we in just all ETFs? And so, and that is obviously driven from a year like 2025 when the indexes all did incredibly well. And it's, important to bring up, that there have been bad years like 2022, and there will be bad years again. You can't really predict them when they're gonna be. But similar to the conversation about why do we have international and emerging markets at the beginning of 2025, we went and we did the analysis for that, risk analysis. And over the next 10 years, it's still having that diversification helped a portfolio. So again, it's timely and you're asking the same question that other investment committees are asking. And I think it'd be interesting to do the work.
Yeah, diversification, I get, I mean, if international is down 20% 1 year, it's still part of my personal portfolio, it's gonna remain that, so I get that diversification, I'm more interested in. If the benchmark is down 20%, is John Hancock down 18%, or are they down 30%, what are their peers doing?
Yeah, no, I think
So-
that's fair. Yeah, just like basically our investment manager analysis team will recommend, just so you know, like if there's a severe underperformance or they're in the, bottom half of performers for a long period of time, we get like, they're gonna be on watch.
And I have
okay?
no doubt you guys are doing the
Yeah,
research.
no, so it's similar to when we have stuff in the DC plan, right? The managers that we're doing an analysis on there. So our team will come to us and say, there's either a structural or a performance-driven problem here. And if it's structural, it's something like the PM is left, or there's assets going out the door, or the team left to go to another, firm, or whatever it may be, right? So those will be situations we certainly would look to replace a lot of them. The other half of it's all the quantitative data that you're talking about, which is, again, how is it relative to their peers? How is it relative to the benchmark over longer periods of time? How do they do in bad markets, good markets, up capture, down capture, that kind of stuff? And that's all on these due diligence pages that we have.
Right,
So we will just include those, for the next,
yeah,
next
it's not that
meeting.
many.
We
not
can
that many
pick a
managers.
handful of managers, we can go over all the managers, whatever you wanna do. And talk about, how they're doing relative to their peers. Because to your point, if John Hancock is not the right manager for this, particular style that we wanna have them for, then we should look to replace them and put them in, put a better performing manager in there.
And you know what, that's not even my point, because that's your call in many ways.
Yes.
I'm just I'm more of a curiosity factor on the information.
No problem.
Can I ask
Yes,
probably a
Sure.
very naive gating question on this plan in general? At Conover, I think 4 or 5 years ago, we elected, I want to say 336 status, if I got that code reference correct, where we engaged a fiduciary on our plan. So we were not actively choosing the investments as opposed to sitting with our management team and our advisory team and seeing what the options are in the marketplace, et cetera, and so forth. Everything you're talking about now, benchmarking, management teams, et cetera, et cetera. In these plans that we're evaluating, are the active decisions ultimately made by the town of Old Saybrook and this board, or has the control of the investment strategy been given to a fiduciary?
We'll let Kevin answer that.
Yeah, so first of all, we are fiduciaries, we're co-fiduciaries with the town in terms of the plan. It's in the contract that we have with you. You're talking about a 338 too. So a 338 is for an ERISA plan, and you get discretion over the investments to change the investments, without a formal vote. What we have in the IPS right now for the town's pension plan, and we're not a 338, okay, because it's not an ERISA plan. So there's just different sort of language and stuff, but we are still a fiduciary. Is basically we can make asset allocation changes on a discretionary basis. If we're going to change a manager, then we bring that to the board. And just to discuss whether this is going to be something the board will be comfortable with or not.
Okay, but so the authority sits with both sides.
I would say, again, asset allocation decisions, discretion. So if we wanted to move again from high yield to investment grade, we can do that without board approval. If we're going to make a complete manager change, we come to you and say, we want to make a manager change because of X, Y, and Z. I would say in the past that required a board approval. Usually now it's just more of a discussion to make sure that the board is comfortable with the changes that we're suggesting.
All right, thank you.
Yep.
Yeah, we're not buying stocks. The committee's not directing. We're not micromanaging this at all.
We've spent a lot of time talking about asset allocation over the years and regarding our investment policies and which we have an investment policy statement, which you may find of interest, but most of our time has been spent on asset allocation, which probably accounts for most investment performance. And I think within that asset allocation, Kevin is certainly, I think, expected to make adjustments on an interim basis.
Thank you. It all makes sense. Just trying to benchmark myself inside the conversation.
Great, thank you, Jim.
No, great question. Then quickly go to fixed income.
Sure, we can move to page 20, which shows the fixed income and the bond holdings. And you can see, in the row of columns in the middle, that we are primarily, on the short end of the curve. So 2-year, 3-year, 4-year, largest allocation is in that 4-year. Just as a reminder, and you'll see it on the next page, is that we do have laddered strategies in our fixed income. So we own the individual bonds. Typically we hold them until maturity. So even though you will see, here, there's actually a paper gain here within the bond portfolio of over 230,000. There are some losses that you'll see going through the pages. But we typically hold the bonds to maturity and then roll them over into another, into another bond. If you look at the yield to maturity, yield to worst, which is in the top row here, yield to maturity is 4.64%. Yield to worst is 4.38. So just, hovering, around that 4.5% for a modified duration of 2.61. So really nice to get, all that great, yield and return on, not only in terms of the return, contributing to the portfolio, but also the yield and on a very short, generally a short, term holdings.
Any questions about that? I'd just say page 28, maybe, just like last thing, just looking at, again, we talked about the constant sort of asset allocation that we've had. We basically had this, 65, kind of 35 mix, I guess you could say, over the last, few years here. Because you really have to add the equities and the alternatives. So, tiny de-risking, but really I've had this, constant for quite a period of time, and we feel like it's the right balance to have going forward. Any questions? Thank you for the time as always.
Thank you.
So, anything else on your end for counter fire?
Not for town or fire, but we do have the DC participant education day today. So we're gonna have that after today. We had a pretty good turnout last time, so we're hoping for a good turnout today.
Yeah, we have, we brought in pastry, so on your way out, there's coffee, tea,
Ooh, that sounds great.
bagels. And yeah, we're really looking forward to, some good information we'll talk about the market a little bit. We'll talk about strategies on how to, best practices on saving for retirement. Every single participant within the town has the opportunity to have a financial plan done by our team. Some people have taken advantage of that, so it's kind of a good time of year to remind people that that is something that is completely free of cost to them. No matter where they are on their saving for retirement journey, doesn't matter your age, it could be in your 20s or it could be, much closer to retirement. And then we're hoping to have, we'll also talk a little bit about the markets and talk about tax tables for 2026, so maximum contribution limits and all that.
Do you have a sense of expected turnout?
Yeah,
People, like, sign
did
up or
people
something?
sign up?
We've had a couple of people reach out to us. We really kind of left it to our partners here to kind of get the word out.
We definitely got the word out. We included it in our newsletter, quarterly newsletter to all the employees. I sent an email to all of the department heads at the beginning of the month to make sure that they were aware of the specifics and speak to all the employees as we, encounter them along the way. So everybody's.
Yeah, I'll, if you have time, I'll stop it.
Oh, yeah, it's wonderful.
Thank you for doing that. That's so critically important. It's amazing. I'm 45. It's amazing how bad my generation is in terms of these topics and taxes and retirement. It's totally different this generation, and the generation that's younger than me, it's probably even worse. So it's so critical that you guys do that. So thank you.
It's true.
I'll see if I can drum up, depending on the schedule, if I can, drum up a little bit of interest. I'll tell Bill Claffey to tell his DPW guys.
Yeah.
I'll tell the chief if he has any cops who want to stop in.
Free copy and pastry.
Right.
Yeah, they gotta worry about their future. I mean, he's right, like, the young people, like, my kids are in their mid-30s, they just, they make good money and they don't save any money. Just like, God, kids, save some money, the future's coming.
I will say that we're happy to come back. There have been some years when we've done it in the fall. We did last year in 2025. I don't know if it's just because it was new or we brought in the freshmen so that we had really good turnout at the beginning of the year. But we're happy to come back any time of year.
Yeah.
And we have done presentations to the police department in the past, which have been really great. And we've offered to also do that to the Board of Ed, and so we're here to do, small group presentations, large group presentations, and thank you. Yeah, we do. It's actually a part of the job that we really enjoy, one-on-one with people and making sure that they're on the right track.
All right. We pretty much covered the plan administrator's report unless you have more, Leanne.
Yes, I have two things. One is that I have given Carl my notice of my intention to retire in May.
Wow.
So we have about 4 months left, and I just want to assure everyone that, the transition for the pension plan is underway with Amy and Melissa and, all of our duties that we have to do here. I think we're in really good shape on the pension board in terms of all the long-term policies we're going to be working on, the IPS, annual review, and we're going to get Brown and Brown in here. So we have a plan for the pension board. And the second thing is that I did send around the ADEC, the actuarial determined employer contribution from Milliman. Milliman will be coming in next month and giving their report. The town plan is going to go from 834 to 807, and the fire department plan is going to go up from 276 to 281. And again, that's because of those cost of living changes that were made the last time. But she will go over all of our new Yelena, our new actuary, will go over all of the assumptions and ask for guidance from the pension board before she prints the final copy of our plan valuations. And that's all I have, Carl.
Yeah, so obviously the ADEC this year, even with the officer incentive with the fire department, we are net, we're a little bit down actually. Which is great.
The budget can accommodate that.
Yeah, the budget can accommodate a level funding or a little bit down.
Great.
We're able to do that, which is awesome. And we can talk about this later. I think everybody in this room knows the impact Leanne has had on this pension plan. So, having someone with her experience come in and have the town pension plan, have the benefit of that expertise to get it where it is right now. And I know that's, Leanne just assumed it's her job to do that, but to have that done and get the plan where it is right now, so it's really set for the future, is, I think everybody should feel really good about that. So, it's great to have that expertise. So thanks, Leanne. Of course, there'll be more to come on that. One other thing, anybody have any old business or new business? We'll just lump it together. I have one more thing, but I'll throw it out to the board. Anybody have
I would just like to say on the current business, how disappointed I am to hear the news. I'm happy to hear, for Leanne's sake, I'm happy that she's made that decision, but not for our sake. And I'd love to have her consider continuing on. I know that's not my place to invite her, but I don't know what her plans are afterwards, whether she expects to move to South Carolina or wherever it is she is now.
Continue on as the plan administrator, you mean?
Well, no, not as plan administrator, just a member of the board. Yeah, but
Well,
Because
not my role.
I'm a pension, because I would be a pensioner, I think that the documents prohibit that.
Okay. Good answer.
well, we have had pension member emeritus. Don't forget,
but
we did
Paul,
do that.
The short answer is, I have told Carl that even after I leave, I am here for anything to help out. So I'm happy to help the pension board in any way that I can. And, I can just be whatever you want to call it.
Okay, great. Thank you. Thank you for everything.
Okay, anybody else in the room? Okay, I have one more thing. So I have the chairmanship right now. I am happy to relinquish that. I'm also happy to continue on in the role. I'm in the office every day, so it's obviously very convenient. But I would almost in some ways prefer one of the volunteer members take it over. I'm happy to, I'd be vice chair, so I could always step in. We can have a vice chair, and that way, if that person can't start the meeting or can't be at the meeting will run. But for the next meeting, if anybody has interest in being chair, maybe that can be expressed either to me, but I don't know that I need to be the chair of this committee. And again, I don't mind being the chair. I'm a full member of the board, but I'll leave that to the board. But I'll just throw that out there. And if anybody has any interest in that, please communicate it, and we can work it out for the next meeting. How's that? I'll leave it at that. You all look so excited.
Shocked about the ins and outs.
Yeah, I know. I'm trying to think. Anything else for the good of the board?
I would just like to confirm the news that you delivered earlier about Kathy Marshall. We were able to verify that that was accurate.
That is accurate. Yeah,
I found an obituary.
yeah.
No
All right.
services scheduled yet, but as of, it was,
I think Kathy is like 63 or 4.
yeah, she was,
68, she's 68 and she died on the 16th.
on January.
Yeah. How many years did she have with the town? Do you know?
I do not know that off the top of my head.
Anyway, all right. So very good. I'm sure that'll be reflected in the next meeting. All right. Thank you all. I'll accept a motion to adjourn by Rowena, seconded by Susan. All those in favor signify by saying aye.
Aye.
Thank you.